How does inflation affect the real estate market? In this video, we're going to talk exactly how there's literally a symbiotic relationship between inflation and real estate market. That's a big word, but you can't talk about real estate prices without talking about inflation at some point. The challenge most investors get is they take snapshots. So in this video, I'm going to show you how to take more of a bird's eye view. So think of, flying at 500 feet above it and seeing more of the horizon of the real estate market and how all of this affects and how you can take advantage of inflationary times, okay, to capitalize on the real estate. And stick around. I've got a cool little bonus for those of you that stick around to the very end, and we'll get to that. So let's get right onto this. First of all, what is the relationship between real estate prices, the real estate market, and inflation? Well, there's a number of things that you need to look at. Right now, as of this recording, we're at the tail end of really high inflationary times. Well, I should say high for us. We haven't seen inflationary stuff like this since Carter was in office back in the late 70s, 1980. Inflation was amazing. Not in a good way, okay? Interest rates were at 18 to 20% for a home mortgage. Imagine that. People start complaining about the current rate of 6.9 to 7%. Imagine that. So let's just start at the very basic. Number one, inflation is going to affect the cost of construction. A perfect example of that is side by side. I'm building two properties in exactly the same area. Finished one. We're starting the second one, second identical property. I mean, I'm talking, we paid exactly the same price for the lot, the same exact design, everything on it, it's $100,000 more. So as a builder in that situation, I have to recapture $100,000 more just to break even, which is gonna cause the price point to go up. So if I want to make exactly the same amount of money that I made on the first one, I have to increase the price by $100,000. In this case, in that situation, geez, I was thinking about that. That's like 31% increase. That's big. So it affects it in a big way. So there is a big difference between eggs, which is everybody wants to talk about right now, being $3 and all of a sudden being $4 or $3.50 and then being $4.50, as opposed to a house being $350 and now it's $450. So how does it affect the markets? Well, if the price of the house is more, then I have to borrow more money. If I'm borrowing more money, I have to make more money to qualify for that. If I'm making more money, the person that's paying me, at my job has to pay me more. That means they have to charge more for their product. It's just what they call a circle jerk. Everybody is being affected by this. You can't sit there and say one person goes, oh, I got to increase the prices. And they're going, okay, if I increase the price, in order to afford that, I've got to make more money. In order to make more money, I've got to go out and get a job that pays more money. And I could be looking in exactly the same industry for a new job, but I've got to find somebody that's willing to pay me more. Now my employer is going to look at it and go, okay, in order to fill that position, I got to pay more. I'm seeing it in my industry alone. My team cost me more than they did, obviously, 5 years ago. And some people say, well, that's obvious. Prices go up. Not like they have. So it affects it that way. Number two is the price of real estate as a whole is affected by several things. Inflation is definitely one of them. So if I've got building costs going up through the ceiling, like in this scenario, then all of a sudden people look over and go, wait, it's going to cost me a lot more money to build, so I might as well go ahead and buy pre-existing. So what's the relationship there? If inflation has caused construction costs to go up, so it's going to cost me more entry point, it might be cheaper for me entry level to get in at this side over here. Okay, can I still buy this property over here? Well, now I've got more people not looking at this. Now they're looking at resale properties on this, which drives that market up because I've got more people looking at the same inventory. And then you've got outside influences where people could say, like COVID, a lot of people, I don't expect us in our lifetime to see something like that again, but that drove prices up for a completely different particular set of circumstances, which was supply and demand. Literally capitalism at its best, if you will. There was supply dropped like by 40% and demand went up by 20%. So you got so many more people looking at so much less property, it drove up prices. There's bidding competition and all that good stuff. So we're kind of coming out of a wonky situation, and that's how prices, inflation is going to affect the market as a whole, really in those sectors. The cost of construction, and then it's going to push other things that's going to drive that price up. This is why real estate is such a good hedge against inflation. Now, the good news, yes, there is good news. I own a time machine. Okay? No, I'm not going crazy on this and smoking the wacky tobacco, as we used to say back in the day. Literally, one of the reasons I love doing the investments of tax liens and tax deeds is because literally it allows you to go back in time and secure a property before inflation took off. So let me explain that. What is a tax lien or a tax deed certificate on a piece of property? It simply means that somebody has failed to pay property taxes on a piece of property. Okay, this has been around for over 250 years. It didn't just pop onto the scene. Okay, so what that means is this. Somebody has a piece of property and they owe property taxes on it. When they fail to pay the property taxes to the county, okay, the county, if I'll back up, does the county need this money? Yeah, they need this money. Okay, this is the purest form of government. They don't have a Federal Reserve printing money. They don't have any of that stuff. They have a budget that is literally tied to property taxes. They know exactly how much money they're getting, and that's what they can spend. This is why you see California going up and down, okay? Because their property values go up in bigger swings and down in bigger swings because of market values in there, which affects the county coffers. Number one, probably 55 to 65% of all property taxes go towards schools. Then you've got roads, bridges, fire department, law enforcement, hospitals, libraries, all what they call these essential services, so to speak. If you don't pay those, that's not really fair to everybody else that's using the infrastructure. So way before we became a country, like 100 years before we became a country, they said, hey, this is the way we're going to do it. We're going to take property taxes on it so that when somebody owns a piece of property, they're taking a percentage of the value of that, putting it back into the county coffers so we can start this infrastructure. Exactly what England did. Okay? The only difference is the property taxes stay with the property. So if somebody fails to pay the property taxes, okay, the property owner owns those to the county, not me. So once a year, the county says, here's the people that haven't paid the property taxes. Okay? We're going to offer those up. So I can go in there and put up the money for those delinquent taxes. I'm not dealing with the property owner. I'm dealing with the county. They're going to give me a certificate that goes on file down at the county courthouse, and this bears an interest rate of anywhere from 16 to 25%, mandated by state law. Once the property owner comes in to pay the property taxes to the county, not to me. They don't owe me the money. They owe the county. They pay that money. The county sees that I'm the lien holder of record. They go, okay, thank you very much. And they cut me a check for my investment plus that substantial interest rate. That is one. The second way, some counties out there go, we're not going to sell the lien. We're going to wait. They've been delinquent for 4 to 5 years. And then we're going to go ahead and sell the property for the back taxes. So I go in there and I say, hey, I would like this property. Let me give you an example. There was a property recently I saw go out. I didn't get this one. One of my students did. It was like $52,000, and they got a $175,000 property. So that's the Wayback Machine, okay, what I call the time machine. So they bought this property at that. They put about $50,000 in, so they're in at about $100,000, and it's worth $160,000. It's almost like they went back 5 years and bought it at this value over here. That's what I call the Wayback Machine. So you're seeing these things going, and the first inclination, especially for new and uninformed investors out there, is I got to buy into this market. No, you don't. Okay, I've been doing this for 30 years. So it's a great way for you to step into what we call that Wayback Machine and make that happen. So that's how inflation affects the market, and that's how you combat that. Now, if you want to learn more about this, it's really simple. Go down to the bio down below or the link or whatever that is, hit the thumbs up, type in any questions, but more importantly, if you want to talk to my team, click the link on there. I got a whole training outline on this for free. My gift to you, just click on that. I go through a whole training on that and get you off to the races. So we'll see you on the other side. God bless and good luck.